Hi everyone, welcome back to our channel. Today we're diving into some major economic updates that are shaking up the markets. From the Federal Reserve's latest decisions to the European Central Bank's concerns about cryptocurrency, we've got a lot to cover. So let's jump right in. First up, the Federal Reserve has decided to keep interest rates unchanged, citing ongoing economic uncertainty. This decision has led to a slowdown in their quantitative tightening efforts. The crypto markets are reacting positively. Bitcoin surged by 3.5% following the announcement. The Fed also projected 2 potential rate cuts by the end of the year, which has boosted market expectations. Analysts are even predicting that Bitcoin could reach a staggering $200,000 by 2025 or 2026. This Fed decision seems to provide a buffer amid fluctuating trade policies and economic forecasts, even as signals of a potential slowdown loom. Now shifting gears to Europe, an official from the European Central Bank, François Villeroy-de-Galhau, has raised alarms about the United States' lax cryptocurrency regulations. He argues that the US's pro-crypto stance, combined with weak oversight and reduced SEC enforcement, could trigger a financial crisis. European officials are worried that US dominance in the crypto space could undermine their monetary autonomy. They are calling for stricter regulations to safeguard against potential instability. With past financial crises often originating in the US, the ECB is stressing the need for stronger safeguards to prevent another disruptive economic event. On to the UK, where the government is set to pilot digital Gilts, new short-term government bonds issued on a blockchain platform. This initiative aims to enhance liquidity and reduce costs and streamline debt issuance by cutting out intermediaries. Chancellor Rachel Reeves is leading discussions with major fintech firms like Revolut and Vice to shape this project. The pilot is expected to launch within 2 years, aiming to modernize the UK's capital markets, improve transparency, and speed up settlement times. The People's Bank of China has announced a sweeping initiative to integrate artificial intelligence across its financial sector. Their 2025 plan focuses on automation, cybersecurity, and regulatory oversight, urging banks to upgrade their IT systems and develop proprietary AI models. Over 20 institutions have already deployed AI for fraud detection and customer service. However, challenges remain in merging AI with legacy systems while ensuring compliance. As China pushes forward, analysts predict that AI-driven financial services will reshape the banking industry, giving Chinese firms a competitive edge in global fintech innovation. Finally, let's take a look at emerging markets. In February, these markets recorded a $16 billion foreign inflow, driven by strong investments in Chinese stocks and Latin American markets. China's equities attracted a whopping $11.2 billion, but bonds faced a $15.1 billion outflow due to regulatory and economic uncertainties. Investors are increasingly favoring Latin American assets, while Africa and the Middle East saw declines. February's figures mark a slowdown from January's $21.2 billion inflow, reflecting growing caution in these volatile global markets. Let's take a look at the economic indicators for this week. Core retail sales met expectations, rising 0.3% in February. While this suggests stable consumer demand, the previous month saw a negative 0.6% drop, indicating that spending is improving but still lacks strong momentum. Retail sales came in much weaker than expected, showing only 0.2% growth compared to the forecasted 0.6%. This follows a sharp 1.2% decline last month, suggesting that consumer spending is recovering but still weak. Lower spending could indicate declining consumer confidence, which may impact overall economic growth. The lower than expected bond yield indicates strong demand for US Treasury bonds. This reflects investor confidence in government debt and could signal expectations for potential interest rate cuts in the future. A big beat on housing starts. The construction of new homes jumped to 1.501 million, well above the forecast of 1.380 million. This signals strong demand in the real estate market, even in the face of high mortgage rates. Builders remain optimistic, which is a positive sign for the economy. Oil inventories rose sharply, nearly double the expected amount. This suggests weaker demand or higher supply, which could lead to lower oil prices. If this trend continues, it might provide relief at the gas pump, but could hurt energy sector stock. The Fed held rates steady at 4.50%. However, markets will closely watch the Fed's forward guidance. Will they hint at future rate cuts, or is inflation still too high? This could drive market volatility in the coming weeks. Jobless claims remain steady, suggesting that the labor market is still strong, with no major increase in layoffs. A stable job market helps support consumer spending, which is key to economic growth. The Philadelphia Fed Manufacturing Index came in above expectations, signaling strong business confidence in the manufacturing sector. However, the decline from last month's 18.1 suggests that growth momentum may be slowing down. Home sales beat expectations, coming in at 4.26 million. This shows that buyers are still active despite high borrowing. The US leading index fell by negative 0.3%, indicating slower economic growth ahead. A declining index can be an early signal of recession risks, as it reflects weakness in key economic sectors. Investors and policymakers will be keeping a close eye on this trend. Next week, market attention will be focused on key economic indicators and earnings reports, including S&P Global Manufacturing PMI, CB Consumer Confidence, quarter-on-quarter GDP, and month-on-month Core PCE Price Index. Meanwhile, several major corporations are set to release their earnings reports, including KB Home, McCormick & Company, Enerpac Tool Group Corporation, Intuitive Machines Incorporated, GameStop Corporation, Canadian Solar Incorporated, Chewy Incorporated, Sabesp ADR, Lululemon Athletica Incorporated, and Carnival Corporation. That's a wrap on today's economic updates. What do you think about the Fed's decisions or the ECB's concerns? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and we'll see you next time.